All right. First thing I want to check is the price of oil. I didn't realize, when I started investing, how important the price of oil is. Um, Oil is a major input to almost every product that we buy. So when we watch the price of oil, it gives you a vague idea of how the economy is doing around the world. Global demand for oil increases as the economies around the world get better. So we had a jobs report today that was better than expected. I mean, they had a lot of jobs. That means the economy in America is doing really good, and it's not even close to being in a recession. But we just had this oil go down 10% in a week, which is pretty amazing. There's a lot of people that say why that happened, but that's we have some excitement today that the ExxonMobil is buying a shale producer, and a lot of times whenever there are takeovers, the stock market goes nuts and just starts wondering who's going to be the next takeover candidate. So what we're going to do is we're going to look at the S&P 500, as we always do at the beginning of meetings. Okay, we're going to look at the graph first of our. Okay, there it is. You can see we've been following this pretty. Every time we hit the bottom of this channel, we're marking it as, hey, wait a minute, we're approaching, the bottom of our well-defined channel, and we're also oversold. We're at 13. Can't get much lower than 13 or like that. But right now, we're also being protected by our 200-day moving average. And Alex notified me that there's a 300-day moving average. I didn't even think about it, but there it is right there. Whenever you're in an uptrend like this, and if you break out of this channel, like right here, you have the 200-day moving average as a next level of support if the channels don't help. So if we look at this really close, you can see that we got within 0.5%, not 1%, 0.5%, close to the 200-day moving average. And that was like a support level this past Thursday. And we bounced off that. So we're at a point right now where we're oversold. People are fearful. Extreme fear is in the market. And the fear is primarily what are the ramifications of higher interest rates. And right now, let's look at the S&P. So you can see this 200-day moving average, which is green. That is basically a floor for the stock market as we go up in this upward channel. And we're oversold, and we have fear in the market. So all the contrary indicators are telling us that it's either time to buy or time not to sell. And we're approaching 3 of the best months of the year, seasonality-wise. We are in 3 of the best months of the year. So let's look at our meeting notes. Okay, so we correctly predicted that September was going to be a bad month because it is always it's typically a bad month. We can't count on that, religiously. You can't really say that's going to be like that every time, but seasonality works most of the time. And October is one of the best months of the year, primarily because we have earnings coming out in October. We look at our calendar of events. I added 2 things. One is banks start earnings next month. So, and that next week. So we're going to have JP Morgan and Citibank, a lot of the other banks starting out with earnings next week. So that could be a catalyst for stocks to go up. It could be a catalyst for them to go down too if they're not good enough. Now we have the tech earnings coming out later in the month. So like Apple is coming out on the 23rd, and we have a lot of other big tech stocks reporting then. So so right now we're we're oversold. We're super fearful in the market, and if we have good earnings, that could take us to the top of this channel. And that's kind of where it's playing out right now. We do have the potential of a financial problem with rising interest rates affecting banks and other parts of the economy. Okay, so what else we have to look forward to? We have a Fed meeting date, November 1st, and we have a holiday, Thanksgiving, November 23rd. So that's why we have green around the holiday, because a lot of times people are happy around the holidays. And then towards the end of the year, we have what's called a Santa rally, which is a lot of times around Christmas, and New Year's we have positive market action. So with Christmas, and we have New Year's after that. So now we have another Fed meeting in December. That's the other thing we have to think about. All right, so now let's look at some of our meeting notes here. The 10-year and the 2-year, 10-year is up 4% from last week. 2-year is basically unchanged. And that's this 10-year is up primarily because there's some strength in the economy, and we have a good jobs report today that made the 10-year go up. So let me see. All right, so we're losing momentum in the market, though. You can see that we're oversold. We have only 12% of the S&P 500 above the 50-day moving average, only 35% above the 200-day moving average. So we're starting to see a lot of S&P companies hitting new lows instead of above moving averages. So that is not good. That's market breadth is like pretty bad right now. That means until today, we had more stocks going down in a major way than going up. So let's look at the US dollar is continuing to strengthen. And that's bad for stocks because at least 50% of at least 50% of the big tech stocks, their sales are overseas. So they're going to be hurt by the strong dollar. And that's going to be something that they say in their reports. Okay, so let me see. All right, so that's all we have for this page. All right. And we already talked about this. We're oversold, 13 and oversold, and we're at the bottom of our channel right now. Okay, so our major variables in the stock market. Crude oil is down 10%. That is a major amount. It seems like Saudi Arabia tried to reduce supply, and that increased the price temporarily, but it reduced the demand. So people are seeing high oil prices, and they're not driving around. So that's probably why that price of oil is down. And current inflation is still 3.67%. The U.S. dollar is up another 1% this week. It just keeps going higher. And gold is losing its usefulness right now. And there's no need to flight to quality when there isn't a debt crisis or any problems with banks or problems with the U.S. Economy. Let's look at the fear and greed index. We've hit extreme fear. That's whenever we have market participants afraid of what's going to happen with rising interest rates. So we are it was around here, fear last week. So whenever it gets to extreme fear and the VIX gets above 30, then we know we're at a capitulation. But right now we're just kind of still at the fear level. You see. Okay, the US dollar went up 1%. We already said that. And one thing that I mentioned earlier is 50% of the Magnificent Seven earnings come from overseas. Apple's earnings overseas is 57%. So we have to wait. We have to know when earnings come out in a couple of weeks for tech stocks, they're all going to say the U.S. dollar hurt our earnings. So the VIX is continuing the downtrend. You can see we're at 18 right now, which is pretty much the top of that range, and the next stop could be down here, which is complacency again. So we had an elevated level of fear this week, but there's a good chance if we have good earnings, it'll go back down to here. All right, so where are we in the fear grief on our emotional chart? We're basically fearful, and between fear and capitulation right now. The fear right now in most people's minds are overpriced, expensive stocks. We're actually not high gas prices because they're coming down 10%. And the other big thing is interest rates going up, affecting every aspect of borrowing money. So that is what caused the sell-off this week and last week. All right, so the big news today was job reports. It came out better than expected. So the United States economy added 366,000 jobs in September. And that means the economy is doing good. It's a very good indication we're not going to go into a recession. We're not going or close to being in a recession. So hold on for 1 second, please. Hold on for 1 second. Okay, so the economy is seemingly doing pretty good, and we're adding jobs. But whenever here's a quick understanding of this. Whenever you have a great job market, you have and you don't have a lot of unemployment. That's bad for stocks because interest rates need to be raised to cool the economy. And when the interest rates are raised, the cost of capital for companies go up. And that makes them less profitable. And whenever U.S. Treasuries go up with the interest rates going up, investors have an alternative to stocks. So if you can get a 10% return in Treasuries, which are free, you're not going to put your money into utilities, which pay 5%, and you have a risk of them going down. So that's why that's kind of why the job if the jobs are 336,000 jobs, and that's a great blowing past expectation. That's why it's bad for stocks. But it's also good for not having a recession. So let's hope we don't have a recession. I follow this guy, Dan Niles. He's really good. He's really spot on. He runs a mutual fund called the Satori Fund, and he said this comment today: strong job number, but slightly lower AHE than expected implies Goldilocks scenario of strong economy with declining services inflation. But implications of higher for longer mattering for more now for bonds versus S&P. Still believe S&P rallies from oversold on any catalyst. So I've marked down here, catalyst, we're getting earnings coming out this month. So that could be a catalyst for stocks to go up. And you see, he said it's a good risk reward for stocks right now because we're oversold, and the Magnificent Seven should be doing good. He still doesn't like Apple, but he likes the big tech stocks. One thing he said that could go wrong is a disaster with another financial disaster like we had with Silicon Valley Bank. All right, so that's good to keep his comments in mind because he's usually good on the big picture. Here's a picture of the U.S. Treasury. You can see since April, this is one of the largest increases in U.S. Treasury rates in history. And this, we don't know what this is going to cause as far as affecting the economy and affecting, borrowing costs for stocks. So it's we never had this situation before. we have people coming out now that are saying stocks will be significantly higher by year end, and there's some people that say that we're going to have a crash. So sometimes you have to like understand, some of these people have said the same thing over and over again, and a broken clock is right twice a day. So you can't really take everyone like they know what they're doing. So this guy, he said in 2022 that we should have significant higher by year end, and then it went down 20%. So one thing he didn't note in this is made pretty much made a lot of sense. The yield on a 10-year Treasury note traded 4.7%, above that of Greece, where and Germany. And U.S. inflation is lower compared to both of those countries. So the 10-year might not be a direct relation to inflation. So what this Fundstrat person says is inflation is coming down, and that will help the stock market. So let's see what the other people say. The collapse in Treasury bonds by year end is now ranking among the worst market crashes in history. So Treasury, this chart that I'm showing you right there of Treasury rates, that is in line with the great financial crisis loss for stocks. So another article says bonds in the greatest market, a bear market of all time. So what everyone's saying is the price of money, the amount it costs to borrow money to do corporate dealings is higher. So you're going to have it's going to cost more to fund a company, and you're going to be less profitable. So Bank of America says to sell the RIPs, and the upper half of the S&P's range as they're convinced bear market has unfinished business. So this is the opposite side. Bank of America says that the price of money, the cost to borrow money and grow your business is going up. So the bear market is still going to happen. Okay, so we'll keep that in mind. Let's see. Okay, so here's another little article I found about Bill Ackman. He runs a fund, and Pershing Square is the name of his fund, and he bought Alphabet, and he said, he's a Warren Buffett devotee, and he follows the principles of Warren Buffett, and he's Bill Ackman is the kind of person who makes really big bets on companies, and a lot of times he's right. Like last year, the year before, he was accumulating Chipotle, and Chipotle ended up being one of the best performers in the whole stock market. And so he bought Google when it was $94 or so earlier this year. So he saw it as a very predictable stock, Alphabet. So he said he prized predictability when finding stocks to buy. He also mentioned that whenever Warren Buffett invests in stocks, Warren Buffett has an advantage in Berkshire Hathaway in that he has permanent capital. Whereas if you're a mutual fund, you don't have permanent capital. People are selling and buying all the time. So you have to pretty much liquidate whenever people take money out of your fund, and then you have to buy whenever people are interested in your fund. So that allows for long-term investments. So this Pershing Square is a long-term investment place. So people can keep their funds there and know that they can buy and hold. So here's some of Pershing Square's top holdings. This is the highest, which is Chipotle. And then next is Google after recent purchases. So you see. These other ones are very interesting. They're Howard Hughes, Hilton, I couldn't find any real good reason why he would want to buy those, because they're all different industries. I couldn't find it connecting, a egg ratio or anything that would explain it. But he's very successful, and sometimes when you're a value investor, you have down years and people lose faith in you. But I always follow him because I know that he's following some principles that worked for Warren Buffett. So I have confidence in what he does and the stocks that he chooses. Okay, so that brings me to the point where, where I like watching Warren Buffett and what he does, and I like watching people that follow Warren Buffett, such as Bill Ackman. And so mutual funds, they have a lot of responsibilities. They have to buy and do the research, stocks that they're going to buy and hold for a long time. And you get penalized as a mutual fund for selling out of stocks. You have to do some kind of selling and some kind of buying every day to meet the needs of customers if it's not a closed-end fund. So watching the holdings over years is a pretty important thing, because if some of these stocks that are quality stocks that are held by these quality mutual funds, if they hold them for 10 years, there's a very good chance that they're continuing to perform. And if any of these, that are on this list go down, you have to really consider adding them if you're interested in a long-term stock to buy and hold for growth in your portfolio. Okay, so what I did was I put 2021, I made a list of all the holdings in the fund, and I did the same thing for now. And so in 2021, they held Amazon, but they don't have that now. Well, they do have it now, but they own like double the amount. So they reduced their position in half. They totally got rid of Alibaba and Tencent and PayPal. And they basically, look at this. They tripled their Microsoft at the T. Rowe Price Blue Chip Growth Fund. They tripled their Microsoft, 14%. So they have a lot of confidence in Microsoft's business model. And look at this, Apple. They basically tripled their Apple position. So they must have a lot of confidence in Apple's business model to do that. In NVIDIA, they added that position. It's brand new, but it's a 6%. So that's a lot of confidence to have to put 6% in one stock. And then Tesla, they added. All the other ones, they kept the same. So whenever I hold, MasterCard, I see, well, they haven't changed their MasterCard percentage, in 3 years. So it's a very good chance that that's something they're going to continue to hold. But we're going to do that exercise with a couple more mutual funds, because I think it's pretty neat to go through that every once in a while. 2021, Fidelity Magellan. This is one of the largest mutual funds in the country. And Fidelity Magellan now, we have less Apple. They sold out of the Apple position, and Amazon. And maybe because, you think of why they did that, the PE of both of these is elevated. It's like both of them are overvalued. Apple is overvalued by 3 times. Amazon probably two or 3 times overvalued. But the ones they added, let me see, Eli Lilly. We've been talking about Eli Lilly for a while. They have 2 potential blockbuster drugs in the pipeline, one for losing weight and one for Alzheimer's. So the Eli Lilly is scheduled to grow about 30% if they're right with their estimates. Broadcom, we talked about them a couple weeks ago. This is a very low PE ratio stock that pays a dividend, and I think and they make chips, and they could be considered an AI company. And Costco, we've been following that. And they have very consistent renewal rates for their members. So the membership fees are most of what they make. And if they increase those, that's the catalyst for that stock to go up. But again, we have a very large position in Microsoft. Not sure they increased it from 6% to 8%. So for a company, for Fidelity Magellan to do that, that takes a lot of guts to put a lot in one stock. So they must have a lot of confidence in Microsoft. Let's look at Contrafund. Contrafund, they got rid of CRM, that's Salesforce.com. They got rid of Visa, and they got rid of Adobe and Netflix. So I'm not sure what the combination, why they would get rid of those. Adobe is starting to come out with products for AI, which they can right now be considered an AI company, and that might give them a certain premium. You have Visa; they're pretty consistent. They're not that overvalued. CRM, they are pretty overvalued. So maybe that's why they trimmed that. And Netflix is they're selling a lot. They're very overvalued there too. Let's look at the ones they added. They added Meta. They're pretty fair valued company. Berkshire Hathaway is a little conservative. We've been following that. Apple and Nvidia and Eli Lilly. Okay, so that's great because we're following a lot of these stocks that are in green that they added, and the ones that they keep, the Microsoft, they're keeping it the same percentage basically. Amazon, United Health. Okay, so if you're developing a portfolio you want to buy and hold for a long time, it's a good idea to go through some of these mutual funds just to get some ideas. Okay, so I did notice that the S&P, we went down in the S&P basically to the bottom of the upward channel. But I did notice that the QQQs broke through its 200-day moving average just a little bit, but it's still right there at the moving average. So we don't. So right now we potentially have a downward channel starting in the QQQ. This didn't happen in the S&P, but we're basically on the QQQ. We're hugging the 200-day moving average, and if we have good earnings, this is probably gonna hold, and we're gonna go back up to here. So the pattern is we're going zigzag up the channel, and if we can hold here and go up to here, that channel's resumed, and we're still oversold. So let's look at other things. Okay, so this Ozempic, this is a weight loss drug, and it not only affects the earnings of the drug makers, but it's causing a sell-off in other stocks. So there's Walmart did a study, and they saw that the shopping demand changes for people that are taking this weight loss drug because they demand less junk foods if they're not overweight. So now we keep that in mind. We're going to look at the market movers for today, and we're going to see the ones that go down the most. Let's see. Ones that are going down the most are some of those companies selling the junk foods. Let's look at the NASDAQ. Here's an example. Mondelez. This is Kraft's spin out that they sell Keebler cookies and stuff and all those kind of junk foods. You have Kraft Heinz. You have Monster Beverage. Okay, so you have a lot of that one story where where Ozempic threat is causing a sell-off in candy and beer stocks. Almost anything that you would eat if you're overweight or not caring about your weight, that's in the ones going down today. So Pepsi, for instance, they have Frito-Lay, and that could be an overreaction, but whenever when investing, they shoot first, think later, and that's why we have a lot of these junk food stocks going down. And let's look at the ones that are going up. We have a lot of high PE ratio stocks that are like software stocks today. Software and antivirus companies, CrowdStrike, Zscaler. Okay, so we have that theme for the ones going up. So it's basically risk on today for the stock market. We have Pioneer Natural Resources. They are in talks to be acquired by Exxon. So whenever a sector like, whenever a sector goes up like that, like the S&P oil and gas producer ETF, that's up a lot because whenever one stock has a takeover, the other stocks around that in the same sector start selling for a premium because they might be taken out too. So Pioneer went up today. We have a lot of these are stocks that Las Vegas Sands. You have some Wynn Resorts. These are stocks that did good when we came out of the pandemic and people are going back into the real world. And that's kind of what we have. Wynn Resort. Okay. MGM. So a lot of gambling stocks. One's going down the most. We already said that they're junk foods kind of stocks. Lamb Wesson, LW. This stock, I think they're the largest maker of French fries. And so I guess whenever you have Ozempic taking away the fat from people, then people don't use much French fries. So almost every one of these on here are revolving around, the half of them are junk food oriented companies. Okay, let's go back to our talk here. We have we have another person, Marco Klovanovic. He's a bear, and he said brace for a 20% market plunge, and he delivers a recession warning. So this guy's talking about a recession. He hasn't been right all the time either. And we just saw some evidence today that the job market is doing really good. That means the economy is doing good. If we saw like huge unemployment and people aren't going to be spending money and the economy is going to be bad, that's when you have a recession. But right now we have a strong job report, so that kind of contradicts anything wrong with a recession call by this guy. He said high interest rates are creating a break point for stocks. Choosing cash that returns 5% versus he said that's the most prudent thing to do. He said if we keep having high interest rates, then we're going to go into a recession. And we don't right now. It looks positive based on the evidence we have, but we haven't felt the effects of the high interest rates that the Fed made, and it might take 6 months to a year for that to kick into the economy and make things reduce the demand for consumers. So you got to listen to both sides of the coin whenever you're trying to figure this out. But he said consumers are dangerously strapped, and they might stop spending, and that might hurt the economy. Job market is still strong, he said, but you're starting to see the stress of the consumer. If you look at sort of the delinquencies, credit cards, and auto loans, we talked about that for the past couple of weeks. So they remain negative. So what do you do whenever you have people telling you that it's going to go up towards the end of the year and you have it going down 20%? And there's always people on the internet comparing the charts of this year to 1929 and the worst times in modern times. But you have to like understand we follow. You buy a stock and you hold it, and sometimes it's a good environment for stocks, and sometimes it isn't. But the good stocks basically can work through any kind of market volatility, and the quality stocks that don't need to borrow, like the ones we're following, they're not as affected by these kind of interest rate scares. All right, let's look more at what's going on in the stock market. Let's look at the sectors. Okay, so right now we have sector ETFs. Right now, the ones going up the most are gold miners, oil and gas exploration, because the ExxonMobil is buying one of the oil companies today. And we have oil services, everything oil's up just based on that. The ones going down the most, consumer staples. And maybe that's because consumer staples might have something to do with that Ozempic article where there's less demand. If you're not overweight, let's look at the retail. The real estate ETF is down. Telecom. Okay, so basically what this is saying, I have to rephrase now. Interest rates are going up, and expanding. And whenever you have interest rates going up, the demand for safe investments go down. So these consumer staples pay a dividend. Real estate, whenever interest rates go up, it's harder to buy houses and there's less demand. So that's why real estate isn't doing so good. Regional banking, banks have a problem whenever they're stuck with a lot of the regional banks have treasuries that go out 10 years, and the more the interest rates go up, the less those are worth. So that they might have. That's why they're not up a lot today. And telecom pays a large dividend. So any stock that pays a dividend now, the consumer is not going, the investor is not going to buy a utility that pays 5% that could go down when they can buy a 5% sure thing treasury bond without any risk. And that's why you have all these dividend paying utilities is one of the ones down, and the ones that are going up. Okay, let's go to another section here. Okay, let's look at the S&P as the big chart here. We see the 200-day moving average. We like to see this going up. If it ever starts going down, that's a problem, because that means we're losing momentum, and over the last 200 days, it just means we're not going up, and that's and then we might start going down. It's like we lost look at this back here. When we lost our momentum, this started going up. This is our 200-day moving average. When we plateaued here and the 200-day moving average started going down, look at the S&P. It basically went down with it. So we're at a point right now where we're still going up with the S&P. So we do have some momentum. But once you reach a plateau in the S&P, then if you see this 200-day moving average starting to go down, that's a bad sign. So we're still in an uptrend, and that's great for the majority of the stock market. And if we have a good earnings season, then that'll allow us to go up some more. Okay. All right. But if the earnings aren't that great, as we come out with earnings this month, and we have some disappointments, then we'll break out of that channel, and then we have to find some support. So whenever we look at breaking out of this channel, if we go through the 200-day moving average, we have to look at every place that the S&P stopped and went up. This is like floors of support. So support right there, like right there, right there. Then if that breaks, then we got to go to this level and this level, and we don't want it to go down to this level. This is the pandemic low. But right now we're in an uptrend, so we don't have to worry about that. All right. Let's see what else we have to talk about here. Hold on. Okay. Well, I like to review at the end of every talk some of the things we look for in stocks, just in case there's someone looking at this that is new. Okay, let's look at what makes a growth stock a good growth stock. Let's look at with an example. Okay, so a good growth stock, we have a return on equity greater than 12, profit margin greater than 12, market cap, we like big stocks, one's greater than 50 billion, so they're consistent. Forward PE, we like to look at that and compare it to the growth rate. And if the growth rate is 10, the forward PE should be about 10 for a fair valued company. If the forward PE is 20 and the growth rate is 10, then it's twice overvalued. And we like to get PEG ratios around 1 when we buy things, because a lot of times that's when you know it's a fair value. It's selling for its growth rate. All right, so we're going to take an example. Okay, we're going to take an example of a stock, and then we can see it. It has all the parameters we're looking for. And I do a search for, I do a check every now and then, maybe every month. We're going to check out Google to see if it's still growing. The estimates are still around 12% a year. So let's look at this. Its PE right now is 28. That's from right here. And its earnings These are the estimated earnings going a couple years in advance. So we can see they're going up in a straight line, and there's consistency, in the stock in its past performances. So see, that's exactly what we're looking for in a stock, going up in a straight line and consistent earnings. We don't like to see red, and that's an indication that they don't have a quality product, or they don't have control over their quality or the price of the product over time. We like to have a high free cash flow, a PEG ratio less than 1, return on equity greater than 10. They need to have a competitive edge, like maybe a monopoly in what they do. We like to see a dividend and transparent and predictive growth earning streams, and little or no debt, and good management. All right, so that's the keys there. This is, if you go to Yahoo Finance and look under statistics for a company, you'll get all this information that we were talking about earlier. And that's it. I think that's all I had to say for today. But I thank you for coming today. And if you have any questions, let me know. I hope you have a good weekend. I think that's about it for now. Thank you.